Hey guys, this is Vasyl Kokla and Waldry Martey, and greetings from the bee dance. So here at the bee dance, like with the pollinators, we defend and protect the client assets and income so that you can build value for your companies and for your families. So we have a special guest, Waldry Martey from Cross Country Mortgage. They specialize in commercial and residential real estate investments and work with the financing properties. They work with the investors, with various stakeholders to help them maximize the value of their property investments. So we want to get together and talk about the intersection of commercial real estate in accounting and financing, and see how we can help you guys bring those pieces together so you can make more informed decisions and you can maximize value. Going back to value B, the bee's job is ultimately synthesize a new product, honey, that is very valuable in different uses. So like that, we want to maximize value for you. So I'll let Waldry kick us off and give you the gist of some of main considerations in investing in commercial real estate, and then we can segue into the accounting piece.
Yeah, well, Vasyl, thank you so much for having me today on your podcast. Always a pleasure to be here and share knowledge and solutions, as you mentioned before, with our public and the people that are watching our videos. It's super important, and you said something earlier in your intro, something about solutions and just making sure you make informed decisions, right? Mm-hmm. I think a lot of times nowadays people are making the wrong decisions, not because they plan to, but because they failed to plan. They didn't have the right accountant or cost segregation, the right finance person to be able to guide them throughout that journey of preparing themselves financially or to prepare themselves for the business or to buy a property, right? So this podcast is really to share some light on the topic of finance and commercial real estate, and on the topic on how you can use the tax codes that are already meant and built for us to be able to further gain more benefits. And as I was saying to Vasyl offline, how to bring Wall Street to Main Street to the working class, to the people that are actually building this nation, how they can use the same benefits as Wall Street people.
Yeah, and like very often, like people try to dramatize how they became successful in business. I mean, it's similar to a marriage relationship. People ask you, "What's your story?" And people like do this grand romantic story. You met in this beautiful way, or when you talk to somebody how you built your business. And people, like in hindsight, people try to really over-dramatize it, but really it's responding to the need, to the market, to some pain point, responding to some situation. It's very much about like motion. Life is about motion. That's why we say the bee dance. So the bee conveys the concept of cross-pollinating ideas, dialoguing with each other. And then dance is about being active, because the motion trumps the perfectionism. When we are inactive, we are overthinking it.
Yeah.
We're not producing anything. But if we take the action, eventually we stumble into something that does work.
Correct.
Like the bee can go to the wrong location first, then she's like, oh, that's not the source of nectar. Here's the source of nectar. And like even from the example how Waldry and I met, and he told me that his fiance's uncle is Vasyl too. So you see, it's like we're talking. We had the first meeting on Zoom, and we see, and like, what's the probability? Like we like in America, we multiple countries and nationalities, but still, like, what's the probability I'm gonna talk with a person whose fiance uncle happens to be Vasyl too from Slovakia? So we see, like in life, when we meet people, we network, we collaborate, we synthesize something new.
Yeah. Well, it's all about, as you said, being active and constantly seeking the next opportunity, the next knowledge, the next step, the next goal, the next activity. Whatever you have to do is just going out and doing it. Because a lot of people just talk about what they want to do, talk about what they're thinking, they talk about their goals and whatever else, but they're not putting actionable steps behind that.
That's
so
right.
Today we want to set up some actionable steps and some facts that you can start using today so you could benefit yourself financially and prepare yourself so you're not banging your accountant's head at the end of the year, or rather at the beginning of the year, to file your taxes when you should have been taking these steps 12 months ago.
That's right.
So most of my audience for CL are real estate investors or small business owners that are looking to buy a property wherever their business is established. So, for example, I literally have a client right now that's looking to purchase a mixed-use property. So, on the first floor is a tire shop and rims where they mount tires, they do balancing, whatever else, and they sell. And upstairs are 3 apartments, right? So that's a mixed use.
Yeah.
The use is commercial and retail and residential on the second floor. So, you knowing that the client is the owner of a business and is looking to buy the location for his business, and then on top of that have rental income on top of the business, what are some of the benefits or tax codes that the owner can have, or the advantages of owning that real estate versus renting that property?
Yeah, so in tax lingo, it's called listed property. Listed property means that it's mixed use, as Waldry was saying. So it's the beauty of that kind of arrangement is it goes back to the point of diversifying your revenue streams. So if you do your commercial use, you get some revenue there, but you get revenue from your residential use also. And when we talk about the main benefit of owning the real estate, it's depreciation. So the tax code gives different useful lives to property based on the class of that asset. So if we talk about residential property, the IRS says that the useful life of residential property is 27.5 years. The useful life of the commercial property is 39 years. And you have a question, well, why is it longer for the commercial property? Well, it's wear and tear things. If we don't use commercial property as frequently as we use our residential property. So the IRS established the useful life of 39 years. So you buy $1 million property, and that's your initial basis, but then you do some capital improvements that will increase your basis in the property. Then whatever basis you have, you use that basis and you will divide it by 39. And in the case of the commercial property, it will give you your depreciation deduction per year. But for the residential property, it's actually more advantageous depreciation-wise because you will divide it by 27.5 years. So it will give you a bigger depreciation deduction. So that's depreciation is one of the areas. But then Waldry mentioned Schedule E. So when you own rental property, you will place it on Schedule E for rental properties.
Let me pause you there for a second. For some of the people that perhaps aren't as advanced as we are with the lingo.
Right.
Capital improvements, right? What is that?
Yeah, so capital improvements is any investments that you do to increase the value of the property. So imagine you buy a rundown property and it needs like major overhauls and major repairs. So you hire a construction team, a remodeling team, and it costs you 100,000. So when we talk capital improvements, it's not some minor repairs, which will be classified as repairs for accounting purposes, but you're talking about major repairs, major overhauls, major improvements. That's what's known as capital improvements. So you invest 100,000, 50,000, 100,000, like even 10,000, 20,000, that would be fairly major. Substantial. And then so what happens, you take that 1 million original purchase price, then you add your major improvements like that increases your basis. And basis is essentially what you have at stake. And the IRS has 3 categories of rules when it comes to basis or your investments. So first of all, the IRS looks at your basis of what you have at stake. Then the IRS looks at risk rules. It's what skin do you really have skin in the game? Is it some sham? Something super passive? You're just trying to use it for tax purposes. So the IRS says, what's the economic substance? It's like if you're just trying to use playing some games for taxes, if the IRS audits that's like, no. I mean, it's not economic substance. You're just doing that for taxes. Yeah. They want to see true economic substance, so that's why they call it at-risk rules. And then they have so-called PALs, And you're like, what, PAL? Like a body? No, PAL actually stands for passive activity loss rules. Because if you have passive losses, they can only offset passive income. You cannot use passive losses to offset active or ordinary income.
So would you say like the rental, we're using this still example, the first floor, the client's business, second, third floor are apartments. So would you say that a PAL would be loss of, for example, if they were doing the bathrooms and the kitchens inside the rental units, would those be considered PAL because of passive income, of rental income?
Yeah, so the passive, we get into material participation rules. So material participation is like, did you have the basic rules? The basic rule is at least 500 hours per year. That's the basic rule,
Okay.
but there are multiple caveats. So passive activity losses is basically when for most people, non-real estate professional people, owning like renting real estate would be considered a passive investment, unless you're a real estate guy. If you're a real estate guy, it will be active because that's your trade and business.
Yeah.
So it's more of those.
So then going back to, so we broke down, thank you Vasyl for breaking down the
basis and
correct.
How capital improvements increase your basis in the property.
So capital improvements, so right, so the depreciation for commercial you said is 39.5 years.
Yeah, for commercial, the useful life of commercial property is 39 years.
39
for residential, it's 27.5.
So if you have a mixed-use property, would that fall under the 39 or the 27.5, or a mixture of both?
A mixture of both. You'll have to separate the two. You'll have to allocate. So the investor purchases the building will have to allocate the piece of the purchase to residential.
Okay.
And allocate the piece to commercial, and then one will become the basis for 39 years, and another becomes the basis for 27.5 year depreciation.
So right now, if the client buys the location right away, their benefits are the depreciation the moment they buy.
I mean, like the caveat is not the moment they buy it, but imagine they do capital improvements. The asset must be ready for its active use. In the moment when they launch their business and start renting the properties, at that moment, that's when depreciation kicks in.
Right, but I'm saying they're already in the business. Their business is already there. They're just now buying the real estate where their business has been for the last X amount of years. So I would say in the next year, tax year, I would assume they would have some of those benefits.
Right, they will have 39th piece of their overall basis.
So let me ask you this, and now we're going down a rabbit hole, but I have to ask.
Yeah.
Does the time, so someone already owned, this building is, let's call it 100 years old.
Yeah.
Someone has already owned it for 100 years. So technically they depreciated at 39 years, maybe 3 times almost.
Right.
So does it restart for every person restarts?
Exactly, because
every
like with each new owner, the new clock starts ticking.
Okay.
So the point is like the new owner cannot tack on the prior depreciation.
Got it.
We have to restart the clock.
Restart. Okay.
Yeah.
So that's very interesting, by the way. And I'm pretty sure there's some weird things going on why that makes sense and doesn't make sense. But we won't go down there today. That's for another podcast.
Yeah. Right.
So what other benefits would this client have aside from depreciation by taking ownership of this building?
Yeah, so
we were talking about Schedule E.
Yeah, so we were talking about Schedule E. So if you open, anybody can download Schedule E. So you go to the IRS website, irs.gov, and type in the search box Schedule E, and you can easily download the blank copy of the Schedule E. And you will see the first section will be you list your income in the property. Then the second section start listing different deductions such as insurance, advertising, taxes, so maintenance. So you have like if you hire a property manager, you'll take that as a deduction. So you have various deduction that you incurred in order to generate the revenue in this rental business.
So Schedule E is a form on the IRS tax return for individuals.
Yeah, for the individuals.
For individuals, individual tax return 1040s, right?
Right.
that allows you to declare what rental properties you have, and then itemize the expenses in the form to calculate your net income.
Exactly. Yeah, that's.
I should be an accountant.
Yeah. See, you should have considered. You should have considered.
I went to school for accounting, but
there you go.
I don't have the knack for it.
Yeah, I should say Schedule E. Schedule E is not strictly for real estate. You also include Schedule K1 income from pass-through entities such as partnerships and S corporations. So it's not exclusive to the rental. We can put it can be used for other pass-through entities, but one of the biggest main known uses is for rental property.
Got it. Okay.
Yeah.
So within the Schedule E, there are certain expenses that can be deducted as part of from the income that then allows you to arrive at a net income, and that's a further benefit for this client. If he were to buy the property, the mixed-use property, he'll have the depreciation, and he'll be able to write off the expenses of managing the building. So at the end of the day, he's paying himself rent, which he writes off. So that is a great opportunity right there.
Right.
That's putting money back in your pockets. That's Wall Street on Main Street.
Yeah.
If you ask me, right?
Yeah.
Keeping more of your own money, that's the way to go. That's amazing.
Yeah, and then another piece is you work with financing. You help people with finance. So you finance the property, you get the loan. So then what's associated with the loan? You have to pay interest in the loan.
Mm-hmm.
Well, you have pay interest on that loan. You can claim that interest is one of your deductions also.
Okay. Yeah. So there's a number of deductions that you have when you buy. So how about so let's segue into the personal lines, right? Why would a person benefit from owning their own home versus renting somebody else's property? Are there benefits for a single family no rental dwellings?
Well, so when we talk about honeybees, so like that pollen, that nectar that the bee collects in the current period, that's like income statement. But then what we are most concerned about is about what accumulates in the beehive. What accumulates in that beehive over time. It's like the balance sheet. That's the value accumulation that we are striving for. So the idea, as I said, our tagline is like with the pollinators, we defend and protect client assets and income so they can build value for their families, for their companies, and for their families. How do we build value for the family and for the companies? Mm-hmm. One of the ways is from maximizing investments. So the way it works, we need to find those singularities, those levers, that we can leverage in significant ROI, return on investment ways. If I think from the perspective of that beehive value accumulation perspective, I want to accumulate value for my family. Mm-hmm. One of the ways to do it is through real estate investments. Because if you go to Economics 101, we talk about four factors of production. So we have capital, we have land, we have labor, and we have entrepreneurship. Entrepreneur as a driver. Mm-hmm. So like if I have some capital, my idea is to maximize the use of the capital. One of the most common ways is like through buy land or real estate. And then we can labor is like when we hire employees, and entrepreneurship is the creative agent that brings all the pieces together. Mm-hmm. So if we want to manage, if we want to steward our resources well and maximize value, we invest in real estate that helps us build that basis. Mm-hmm. If we build a basis and then we improve that, and then we improve the property, we can sell it at a higher rate in the future. Mm-hmm. So that becomes like a beehive for the family versus collecting and spending something in the current period. So the idea is to beef up the balance sheet, beef up the assets, because when we talk about the maximizing value, we talk about uses of funds and sources of funds. When we talk about sources of funds, there are four main sources. The first source is what we can borrow from the lenders.
Mm-hmm.
The second one from owners, capital from owners and investors. The third one, generate revenue. The fourth one that a lot of people forget is government funds for tax credits, for grants, things like that.
Yeah.
That's our sources of funds.
Yeah.
Then what do we use those sources of funds? How do we maximize value? Well, we can have expenses that fuel a growth, like we can invest in marketing. It's one way to fuel growth.
Mm-hmm.
Or we invest in assets. The goal is to invest in assets that will help us build value. So rather than spend money on rent,
Yeah.
we actually invest in an asset which we can rent, and we get into the entrepreneurial rental activity. And once we get there, we can claim different deductions.
Mm-hmm.
As an individual, I cannot subtract things from my income. If individual on W-2, I cannot subtract anything. I have to report. I can subtract standard deduction, basic things,
Yeah.
but not like deductions like the business owners can deduct. But once you invest in the property that you rent, all of a sudden you have the ability to deduct the expenses that you incurred to generate that revenue. So it becomes much more advantageous for you versus just spending your money on rent. And personal rent is not deductible.
Right.
Unless you talk about the piece of your home which you use for business use, you can deduct a small portion of that if that's your exclusive use. But you don't have any, effectively you don't have any deductions.
Right.
But if you buy an asset, you and then you improve it, and then you also have deductions, annual deductions on the annual basis. So you work from the beehive value accumulation approach, and also in the current period income statement, you maximize your deductions.
So simply put, buy real estate, right? I mean, you have more opportunities, you have more options and more ways to diversify and protect your income and keep more money in your pockets by owning where you live. If you're gonna pay somebody to live somewhere, you might as well pay yourself, and again, keep more money in your pockets, right?
Yeah, and we talk about investing in the community, and if we talk about like having nexus or true connection to the community, and like asking myself a question, how do I really invest in how do I really show that I care about my community? What's a tangible way to show that I care about my community? One of the ways, if I purchase real estate in that community, it's a tangible way, not just in words, but to show like I care about the community, I believe in the growth of this community. That's why I own real estate in this community.
Mm-hmm.
That's a very tangible way to show you that you truly care about the community.
So I know that you're not in real estate directly. You
Right.
work it indirectly, right?
Yeah.
Would you say that it's still a good time to buy a house today in today's economy in October almost of 2023?
When I talk about like mortgage brokers and we talk about the rates, one guy told me this, like, vasyl, in this space it's you marry the house and you date the interest.
Mm-hmm.
So it's like, look, it's like finding that asset that you really like that makes sense.
Mm-hmm.
Interest rate, yeah, it's a high interest rate, but the idea is sometimes like I pay. It's a part of doing business in this environment. Yeah. But it's like thinking, how can I leverage this property investment wise? Some people are so fixated on interest that they forget that they don't see the forest for the trees. And rather than say, okay, it's like higher interest, correct, but it's the higher inflation and the higher prices.
Yes.
So if I buy this property and I can rent it out at a higher price and really leverage that investment, it's going to negate that interest.
Yeah.
So keeping the big picture in mind rather than being like so fixated on the interest. Yeah, it's like we're there in the long haul, it can last for a while, but it's really thinking, how am I going to maximize the use? If I really find a good use for the property, that high interest rate is not going to be much of a factor, especially in the higher price inflationary environment.
So it simply put, it's all relative to what your situation is.
Correct.
If you're wasting money on rent, if you're wasting money on paying somebody else for what you could keep in your own pockets, then probably makes sense for you to look into something that could be your own, where you can increase your balance sheet, your net worth, and increase your cash flow by potentially buying a multifamily where you can get rental income, right?
Yeah, it's like you remember all that frenzy, like COVID frenzy. People started purchasing houses in some markets. There were like 6, 7 offers on the property, so there was like a huge frenzy.
Yeah.
And then people like calling me, asking me, "What do you suggest? Do you think I should participate?" I'm like, "Look, if it were me, I wouldn't be participating in this frenzy. You know, it's blown out like 6, 7 offers. Why am I competing with all these guys?" An advantage of this period is you don't have that situation. You always have trade-offs. You know, in that situation, you'll be competing with a lot of people, like for one real estate, multiple offers. In this kind of setting, the trade-off is like higher interest rate. But the flip side is not as many competitors for the property. So you just weighing those trade-offs.
Yeah. What would you recommend? So something I see a lot as I work with some of my clients is a lot of them will write off so much income that their net income is almost zero or very little, yet want to buy a $500,000 property with a income of $30,000. Now, for $500,000 property, you typically need to make about $80,000 to $100,000, depending if there's rent coming in from the property, right? So, what would you recommend to the people that are looking to write off as much as they can, but yet don't own a house? Like, what is that middle ground? What are some of the things that you would recommend to someone in that situation where they don't want to be held so much for tax liabilities, but at the same time they understand, or you would recommend that they declare some income to not have to then exaggerate the next year?
A big misconception in businesses is I must write off everything. So unfortunately, the way a lot of businesses were taught to think, I must write everything off. So they make an extra million in a year, but they wrote it off, they got back to zero. So then Waldry's scenario comes into play where they cannot show much for getting a mortgage.
Right.
So the key in that scenario is not to write to maximize your deductions and get it to zero. The goal is to actually show profit, because we are building value. We must show profit, and the way we go about it, the beauty of working with the tax credits, it works out like this, because tax credits is like after profit. So you calculate your net income, and you show it on the line called profit. Then you say, here are the credits that we are applying. And unlike deductions are subject to the tax rate. So if somebody in 30% bracket, so if he has like 1,000 deduction, the true tax value to him is like 300 savings. The beauty of tax credits is that it's dollar for dollar reduction. So check this out. So you put this, you say your business made like 250,000 profit. Then after that you claim various credits after that, like bloop, 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 bloop. And then you reduce it like to your profit after credits, and you get it and you get it as close to zero as possible. So when you go and apply for a loan, then the officer sees the profit, and only after that listing credits. So you see, it's like maximizing the use of credits.
Yeah.
And that
I really like that. I never knew. I don't know much about the tax credits.
Yeah.
Can you give us some examples of what are some tax credits that you're currently using for some of your clients?
Yeah, so it's things such as like investment, investment in historic property in the historic district, or the economically depressed district. So we can get credits. We can get credits for that, or low income housing. And then if there are significant investments in the energy efficient infrastructure for that property, then you can claim credits for that too. But especially it's advising people to finding historic properties that in these smaller towns Also, you can find plenty of properties with the historic significance, even if the property is not listed on the in the registry of historic places. It can be listed if the case can be made that this property has historic value. So you just have to work with the preservation societies and Department of the Interior to make it happen.
Okay.
But it's very possible and doable process. Once you list it as historic place, then you can claim 20% federal credit and usually 20% state credit on the restoration of that historic property.
Mm-hmm. And with that credit, is that yearly? Is it over the 27.5 years? How does that?
It's for the eligible restoration expenses.
Okay.
So you buy rundown property and you restore it, so eligible. It's of the eligible restoration expenses.
Okay. And do these credits change every year? There's different credits that the government is giving, or how does that work? Every year you have to do new research, read all the new headliners that the IRS is posting on. How does that work?
Yeah, so it's like keeping like monitoring like different credits because different like credits come up. So for example, like Opportunity Zone program, it's a fairly new program.
Uh-huh.
So things is the monitoring legislation to be on top of that, and to monitor your industry and see what's available in your specific industry.
Okay. So guys, as you can see, Vasyl is an expert at tax credits, havens, and ways for you to be able to save more money on your investment property, on your primary residence, or on the property where you occupy your business. You just have to be informed, you have to read, and you have to talk to professionals like Vasyl and myself to be able to learn about what options you have, right? Do not go to an obese person and ask them how to lose weight. Do not go to a divorced person and ask them how to have a happy marriage, right? You want to go to the professionals that know exactly what they're talking about in order for you to have the right advice, the right, certified professionals. Don't go to ChatGPT, okay? I know that it's a resource. I know that some people are really taking advantage of it. But the fact of the matter is, Vasyl went to college. Vasyl got educated. Vasyl is up to date with all the different things, all the different newsletters and things that the IRS posts. So it's much easier and streamlined to talk to someone and really understand the beehive and the mentality of what it is, right? And stay informed.
Yeah, and I would say I work for family offices. So you work for family offices. So you work for high net worth individuals, families. They have like multiple businesses. So I learned a lot from the business entrepreneur in South Carolina who owned 30+ businesses. And when you serve a company like that, you're a part of interdisciplinary team. You work with the lawyers, you work with finance people, but usually tax professional is a go-to person. He's like a project manager.
Yeah. Because
if that family member needs to call somebody, usually he calls a tax person and say, look, my objective is to accomplish XYZ, could you make it happen? And then the tax lead goes and works with lawyers and finance people to pull all of that off. Mm-hmm. So working in the family's setting like that was helpful for me to learn the value of collaboration. It's like you build a house, you build a property, you need a team, you don't do it by yourself. So it's like making sure that we can handle clients' cases in multidisciplinary setting. That's why, like realizing the value that each of us brings. Like Waldry is in the financing space and he's been doing that for a while. So he knows the ins and outs of that.
Right.
And then for the accounting piece, I can advise on accounting and tax piece. And it's having the right teams to make it happen. And you see, and I met Waldry through his BNI chapter, and in BNI the big thing is givers gain.
Yeah.
So it's like going back to the investment in the community and being invested in the community and saying, how do we create such teams and work together so that we can service our clients best? Mm-hmm. Because you go and ask somebody, where do I get XYZ service? 90% of people say, sorry, I don't know.
Yeah.
Maybe 10% of people say, oh, I actually know this place, go there.
Yeah.
And the idea is, how do we bring value to a client so that we can be heroes for our clients, that we really take care of them holistically.
Yeah.
And I can say, you know what, I think you will really benefit from talking with Waldry because he knows his business. He can really advise you on what site to buy, how to buy a good property for your family, for your business.
No, I definitely do appreciate that. Having a team is extremely important. I grew up playing sports, so I know all about collaboration and teamwork. And not just that, but also coaching, right? Coaching is such an important part of life. A lot of people do not, and we're going to segue out of real estate real quick for a second. It's such an important, integral part of life, right? Whether your coach is the man above, or whether your coach is your pastor, or your coach is a professional coach,
like
business coach that helps you build your business. You always have to be seeking advice from mentorships or people that are at a higher level than you for you to get ahead, right? And be able to excel, whether it's personally, emotionally, mentally, professionally, physically. But the point is to always strive forward, right? And I want to end this podcast with one more question for you.
Yeah, sure.
This is a trick question. What is the main objective of an account? Is it for the client to not pay taxes? Is it for the client to get a refund? Or what is the main objective, would you say, of an accountant?
I would say it's like going back to the value cycle. So it's like the objective of a good accountant is to maximize, to take the client through the entire value cycle. That's why the way our services are structured is like 6 service lines. So if the person of the business is bleeding in the tax resolution situation, what value are we talking about? We must stop the bleed, put the Bentley stop the bleed first. Then we can teach accounting literacy through color accounting. We can advise on business financing, and then we can guide through fractional CFO services about financial and tax measures. And then we can go all the way through sale of the business. Even if you're not gonna sell the business, a good idea is operate your business as if you're gonna sell it, because that way you will really invest in systems. You will be building value. If you just want to have a company, you may not be motivated enough to make a great business out of it.
Yeah.
So the question for me is, a good accountant really brings value to the client. So when the client pays a fee and the client thinks, what am I paying this guy for? It means that accountant didn't provide enough value.
Mm-hmm.
But if the credits came in and that money got deposited in the bank, and the client time comes to pay the accountant, the client know exactly, and he is like happy to pay that.
Yeah.
Because the client understands the value. So I would say the main job of an accountant is to take the client through the value cycle in such a way to defend and protect clients' assets and income, so that they can build value for their companies and for their families.
Got it. Yeah. The reason I asked the question is because, and thank you for explaining that. I was listening to a podcast, Patrick Bet-David. I'm not sure if you've heard him before.
Yeah, I'm
Valuetainment.
sure.
I'll show you after this.
Yeah.
But anyways, he said the job of his accountant is to make sure that he doesn't have to pay tax at the end of the year, so that he's zeroed out. So a lot of times you either overpay or underpay, but very rarely are you met the right number or quota for you to say, I'm good. I have no obligations. My systems and my practices, my business is all set to go.
Yeah.
But anyways, I think it's super important, guys, for you to stay educated, for you to stay on top of your taxes, your financial household, because that is a foundation of all our lives, right? And making sure that we have our finances intact, our mentality, our physical, our emotional, and all that, right? That makes your house. So again, thank you so much, Vasyl, for the opportunity to sit down with you today, and we'll end the podcast there.
Yeah. Take care of yourself. Cool bees.